Welcome back to the Isn't That Rich podcast. I'm your host, Jill Franks.
And I'm your host, Ashley McVicker.
And today we are talking all about the HSA and all of the mystic that is behind that. But Farmers State Bank recently switched our entire employer company to an HSA plan. And we thought, what better time than now to dig through all of the mud that is an HSA plan. And so we've decided to ask our insurance expert, Tatia Wesley, here today to explain all that is the HSA account. So welcome on, Tatia.
Thanks for having me.
So before we get into HSAs and all of that stuff, I want you to tell our listeners a little bit about you, how you became or got into the healthcare insurance world, all that good stuff.
Okay. So I've been in the insurance industry for about 17 years now. Started out as just an account manager and ended up being thrown into a position of health insurance, health benefits, life and health benefits. Self-taught. Basically, my GA, which is a general agent, she taught me everything that I needed to know. Okay. So from the bottom to the top, basically I got it in the mud.
Yeah.
But now I'm here, 17 years strong, and I wouldn't give it up for anything. I love health insurance benefits.
Well, it's so important. And I feel like what is more triggering besides money than healthcare, right?
Absolutely.
One of the most important things for people to be
And then
taking.
paying for healthcare. And it's like the next.
Yes. Yeah. And people don't really understand the logistics of healthcare.
Yeah.
I mean, they're not educated on healthcare. They don't know how to use their healthcare benefits. They don't actually know what their health insurance benefits are to use it correctly. So I'm big on education.
That's great.
I feel like the hardest thing about insurance is just learning all of the phrases and words. Like, I remember when I first started at the bank and I had got my first healthcare policy and I'm like, Jill, what's a premium mean? And now it's like, what's a deductible? And it's all still confusing. So it's nice to have someone in your corner like you that can just be like, this is what's going on.
Absolutely. And if we educate employees on how to use their benefits or what benefits consist of within their plan, it'll save premium dollars on the employer side and the employee side.
Yeah. And that's what it is. It's a benefit. So employees should be taking
accountability.
Accountability and using it to the fullest too,
Absolutely.
right? It's part of your benefit package that your employer provides you. It is a benefit towards you. So if you don't know the ins and outs of it, you're just either leaving money on the table or otherwise you're, anyway.
I agree 100%.
So today we're talking about HSAs, which are health savings accounts, correct?
Correct.
How often are health savings accounts coming up in your conversations with your clients?
2024, 2025, they were a little bit more interested in HSAs. There's so many things that are misleading about HSAs that employers really don't understand that you would open the door for it and they'd say, well, no, we're not interested.
Yeah.
But now just money saving on the employer and the employee side, HSAs are becoming more prominent. I'd say about 20% of my business, I do allow them the option to know and learn about an HSA.
Okay.
And
20%.
HSAs have been around for a really long time, correct?
Yes.
Really
Yes.
long time. Yeah.
Yes. A really long time.
And I'm going to go way back to the basics. So if somebody's listening for the first time and they don't even know what an HSA is, can you explain like what it is? Because it's not just a savings account. It's a healthcare plan, correct?
It's tied to a high deductible health plan is what it is. So in order for you to have an HSA, you would have to have a high deductible health plan, which quote unquote high deductible health plan can be a deductible plan that is $1,700 or it could be $10,000.
Okay.
A little vague with the dollar amounts. You just never know.
You never know. It could be anything in between that. It has to be, the regulations are, it has to be $1,700 or higher.
Okay.
Okay, that's for 2026. The thing with high deductible health plans is that you do not have first dollar benefits. When I say first dollar benefits, that's copays. You don't have prescription copays. You don't have office visit copays. You don't have specialty copay visits. Everything is paid out of pocket up to that deductible amount.
So in easier terms, that means if I wanted to go to primary care because I had a cold and the cost was $200 for that visit, if I had a different type of insurance plan, maybe I would pay a copay of $30 and then my insurance would cover the rest. But on a high deductible plan, you would just pay out of pocket the $200.
Correct, until you hit that deductible amount.
Of $1,700.
Yes.
Well, now, for this example, yeah.
Yes. And it depends on what your deductible amount is and what your coinsurance amount is. So let's just start fresh.
Yeah.
Okay. Deductible amount is basically anything that you need to hit as far as office copay visits, prescription drug coverage, x-rays, ER visit, whatever it may be, that's your deductible. Once you hit that deductible, there could be a coinsurance amount of 80-20, which means that the plan pays 80%, you pay 20%, or it can be 100%. Now, when I choose a plan for an employer group, I always look for the 100%, because once I have those employees hit that deductible, I don't want them to be responsible for anything else.
Yeah.
I want them to be done, and then everything would be covered at 100%. So most people only look at deductibles. They don't look at the coinsurance. They don't look at the out-of-pocket maximum. They just look at a deductible when they shop.
Yeah. So when I hear the term coinsurance, which immediately comes to my mind is that I have to have a supplemental insurance, like another insurance. That's not what that means.
No, that's not what that means.
So coinsurance means?
Coinsurance means that it's basically a split pay. The insurance carrier pays 80%, you pay 20%, or the healthcare insurance carrier pays 70%, you pay 50% until you hit that out-of-pocket maximum.
So that's just like the split between you and your employer.
So you're still on the hook for some money.
The insurance.
Yeah, the insurance carrier.
You're still on the hook for some payments, basically, if you have co-insurance, not a copay, co-insurance.
All plans have co-insurance. Okay. So, and this is where people get kind of caught up in the deductible.
Yes.
When you look for a plan, you should always look for the out-of-pocket maximum.
Okay.
Everybody looks for a deductible. The out-of-pocket maximum means that that's going to be the maximum that you're going to pay for that plan year. So you can have a deductible of $2,500, but your out-of-pocket maximum may be $6,500.
Okay.
And so it's like deductible, $2,500, coinsurance, 80-20. That means once you hit the deductible, you're responsible for 20% of all your claims until you hit that out-of-pocket max of $6,500.
And then hopefully 100%.
After that.
Okay.
Yes. So, like I say, people always shop for deductible instead of out-of-pocket maximum.
That makes perfect sense to me. I didn't know that's how that worked.
Yes.
Okay.
So I always say,
okay, we're learning.
Yes, I always say everyone should shop for out-of-pocket maximum instead of a deductible, because 9 times out of 10, you're not ever going to hit that deductible unless you're having something catastrophic happen.
Yeah.
So regular PPO plans, you have your copays. You're spending a lot of money for a low deductible and copays, but no one's ever using it.
Yeah.
So you're losing money up front because the health insurance carrier is not ever going to give you that money back.
Right.
So if you're not using the plan, you're wasting a ton of money.
Right. I think about companies that have a lot of young employees, a lot of young and healthy employees. They might, if they did not an HSA, they probably are putting a lot more towards this health plan than actually gets used.
Correct.
Okay. Which
Correct.
might be a reason why a company would look towards a HSA.
Yes. And people get it. They misunderstand what a HSA is.
Yes.
They think it's strictly for young, healthy individuals, and it's really not. Because if I had something catastrophic going on and I was fighting terminal cancer or something of that sort, and I know that I'm enrolled in an HSA, and I know that my deductible is $5,000, the maximum that I have to pay is $5,000 a year, that's going to save me some money.
Yeah.
Because prescription drug coverage for someone going through a cancer treatment or any type of lung disease or anything of that sort, it can reach into the $12,000, $15,000 just for prescription drug coverage.
My husband's when we were had some health issues last year, monthly, it was $25,000 for the one drug.
One drug.
Yeah. So if we didn't have health insurance, yeah.
Yes.
So,
and I mean, if I know that my deductible is only $5,000 and I'm on HSA and I have 100% coinsurance, I'm only going to max out at $5,000 every year. I can hit that in January, and the rest of the year my care is covered.
That's great.
At 100%.
Everything.
As long as you stay
you never know sometimes, Tosh, with insurance with the fine print.
As long as you stay in network, everything is covered at 100%.
Well, and that was something too that was new to me as I was looking for providers. You know, I'm not from here. And so I would still, look for healthcare. Like I just asked you for a referral for a physician the other day. And in-network doesn't necessarily mean they have to be in Marion, Illinois.
Correct.
Which was really surprising because there was a doctor that I used to go to that I really like in Minnesota, and they're in-network.
Yes.
So explain what in-network means.
So in-network is an in-network provider means that provider is contracted with the carrier. So that provider may be contracted with the carrier through Blue Cross. They may be contracted through Aetna. They may be contracted through United Healthcare. As long as their name shows as an in-network provider and you're under a PPO plan, you're more than welcome to go to them.
Will you tell me what PPO means? Because I've never learned that acronym. I see it on everything, Tasha. What is PPO?
It's basically a participating provider.
Okay.
I was going to say pay per something with an O.
Occupied.
That was my best guess. Okay, so we're talking about HSAs. We're talking about these accounts. Who is eligible? Well, we talked about who is eligible for an HSA. You said it's a high deductible plan.
Anyone that is enrolled.
Enrolled in a high deductible plan.
Yes.
What is eligible to be paid for with an HSA?
So, a HSA, most people contribute to a HSA. That HSA is basically a medical debit card that they can use for medical, dental, vision, and over-the-counter prescription drugs. So Band-Aids, cough syrup, ibuprofen, Tylenol, crutches, braces for their arm, whatever it may be.
There's some acne stuff too I've seen that you can get.
As long as if you go to a pharmacist or pharmacy or Walmart, Walgreens, CVS, and it should have a little tag at the bottom that says HSA approved. As long as it says HSA approved, you can swipe your medical debit card for that.
So that's if you're out shopping.
Yes. Or if you want to purchase online, you have the ability to use your HSA debit card, I call it a medical debit card or a Benny card. You can swipe that medical debit card online. You can purchase online glasses or some people buy the little vibrating machines now that everybody's
like
using.
The standing one, they shake you, yeah. Right.
Anything that's basically medical, dental, or vision related.
So medical, dental, or vision related.
Yes.
So if somebody wanted to get Invisalign,
yes,
that would
they
count.
can actually swipe their medical debit card for Invisalign.
Okay, I go to the doctor again. I'm just going to keep using this example, and I have to pay that $200 office visit for my cold. Do I use that debit card?
Yes.
To pay for that appointment?
You should, yes. As long as there's funds available on your medical debit card, you can swipe that medical debit card.
Okay.
If you do not have the funds available on your medical debit card, you can swipe your own bank card, debit card, credit card, whatever it may be. And eventually, when you get enough money into that medical HSA, you can pay yourself back from it.
So
keep your receipts.
So let's talk about this. I feel like this is the big part of the conversation. How do you fund an HSA? Walk us through it. How that triple tax advantage account.
So you can either fund it through payroll deduction. If your employer offers the HSA, you can use payroll deductions. It's pre-taxed, so those funds go in before your money is taxed.
You get your full dollar.
You get your full dollar. You can actually fund it from your own private bank account if you'd like. Once again, at the end of the year, you'll get a tax break for funding your HSA through your own personal bank account. The employer can contribute to your HSA. They're not required to, but they can contribute to your HSA as well.
Okay. So by saying that I get my paycheck and I have an automatic deposit, it automatically goes towards my HSA? Or how does that work? Do you know what I'm saying? Like, I don't have to.
So if you do a payroll deduction, then basically your employer will pull that fund money from your account and fund it to your HSA.
Okay.
Yes.
And if you have an employer that is contributing, they take pre-tax dollars and put it in that account too.
Correct.
Okay.
Correct. And then they'll see a tax fund, a break
on that too.
At the end of the year when they file their taxes.
That's great.
So we have this money in this account, pre-tax. We got our full dollar.
Yes.
What's going on next with it? We have two things, right? We can either...
You can use it.
You can use it.
You can save it. Or you can invest it. So most accounts have to have a certain dollar amount in it before you can invest any of your HSA funds. So for instance, majority of the TPAs, third-party administrators.
Okay, yeah.
Thank you.
Listen, Tasha, you know when you say three letters, you got to tell us what they are. I know.
So most TPAs, third-party administrators, they require you to have at least $1,000 in your account before you can start investing. I encourage everybody to contribute into their HSA, even if it's just $10, $20. I mean, you spend more of that on junk at Walmart or at eating out, and basically you're funding your own health care should something ever happen. So I encourage everybody to at least contribute something. Once you invest that money out of your HSA, it depends on your third-party administrator at what percentage interest rate that you get on those. You can pick and choose your own investments, which is good because you're in control of it.
Right.
I encourage everybody, if you're going to invest it somewhere where it's going to sit and just accumulate dollars for the next 10, 15 years, depending on your age. If you are over the age of 55, you can contribute an additional $1,000 per year into your HSA contribution just to play catch up.
So just like any other investment account, kind of.
Yes.
If you're at that retirement age, you have that catch-up clause or whatever it is. Okay, so you can add more to it. I have a question for you, and this kind of goes back to like what you can buy with an HSA, because I think this is a big misconception, is that an HSA account is a savings account, and everything I spend my money on, whether it's that cough syrup, those Band-Aids that you talked about before, that is going towards my deductible. Do you know what I mean? Like, so all this spending doesn't necessarily give me credit towards that. Say it's $5,000 deductible. You know what I mean? It's
right.
So not necessarily count towards that deductible.
Correct. So the only thing that's going to fall to that deductible is what you do medically with your physician, because that's your health insurance. So anything that you have that's medical related will fall to your deductible. That's the only time that anything will fall to your deductible. If you happen to use your HSA for dental, braces, anything over the counter, that's not going to fall to your deductible because it's not considered medical related.
Got it.
So that $200 visit I went to, that falls towards the deductible.
Yes.
And say you got a prescription that, say you have a pharmacy part of your HSA. Is that typically part of it to use the drug? Okay.
Yes.
And if I buy prescribed medicine with it, will that fall towards my deductible?
Yes.
Okay. But if I wanted to have this Aura ring and buy it and it qualifies under my HSA, that will not.
It's not going to fall to your deductible.
What if her doctor told her to get it?
Ooh.
He would have to.
Come on, Tasha.
He would have to give you a prescription and you would have to purchase it through wherever he prescribed it at.
Okay.
In order for it to fall anywhere.
Got it.
Anytime you want anything to fall to your deductible, it has to be prescribed by a physician.
Okay.
Got it.
Okay.
That makes sense. So you have, because there's limits on this too. That's another thing we haven't gotten into. We talk about our deductible, but there is a maximum each year what you can contribute to this
Into
as
your
well.
HSA.
And
Correct.
can maybe, I know we're just starting a new year, maybe you can talk about what those limits are.
So for 2026, the contribution for an individual is $4,400. That's the maximum that an individual can contribute into their HSA for their coverage only. If you're on a family plan, it's $8,750 for 2026, a family can contribute into their HSA $8,750. Okay. If you're over the age of 55 and you're on a family plan, you can contribute an additional $1,000. And if your spouse is over the age of 55, they can contribute an additional $1,000, but they have to start their own HSA account.
Okay. That makes sense. So if I blew a bunch of my HSA money on Band-Aids and cough syrup and Oura rings, and I all of a sudden have this medical bill come up or like this medical emergency and I have not hit my deductible, can I contribute more to my HSA even though I spent that money? Do you know what I'm saying?
You can, as long as you've not hit your maximum.
Okay.
So once you hit that contribution maximum of $4,400, you can no longer contribute anymore for that plan year.
Okay. So I would have to pay out of pocket, not the I wouldn't get the benefit of the whole dollar.
Correct.
Tax,
Right. So you're saying if Jill contributed, you said 4,400?
Yes.
Mm-hmm. Jill contributes 4,400. Gosh, let's say she's like a go-getter and does it in Q1.
Right.
And then she obviously has a heyday at Walgreens and spends $4,400 at Walgreens on cough drops and whatever else is fun there that we want to use our HSA on, full dollar.
Right.
And then you have something that costs $5,000. You have to spend $5,000 out of your pocket.
Yes.
Right. That is already, you don't.
Yeah. And I think that's like the big misconceptions around HSAs. And it was with me too. So I'm not dogging on anybody because I got on the HSA website and I was like, look at what I can buy.
There's some great stuff on there.
There is great stuff on
They
there.
have Goop sunscreen. I mean, my goodness, you can use Goop sunscreen, but probably shouldn't spend my HSA money on it especially if you're in the high deductible plan like we talk about. And that doctor's visit that most people have to go to every year is going to cost you that full dollar amount.
Right. Now, if you just go for your annual WellCare visit, it's still going to be covered up under your plan at 100%, depending on what type of plan that you have. So you need to pay attention and be educated on what type of plan that you have before you start using it. So WellCare visits, 99% of the time, are covered at 100%. WellCare visits are anything that you've not been diagnosed with. So if you've been diagnosed with high cholesterol and you have to go do a high cholesterol screening every year, you're going to pay for that because you've been diagnosed with it. If it's something that you have not been diagnosed with, thyroid disease, anything like that, they're checking you for it, is considered WellCare.
Okay. So what do you do if you're wanting to do this wellness check every year? What do you say to the office when you call?
Yeah. So when you call for your WellCare visit, let them know that you're coming in for a WellCare visit. I'm coming in for my preventive care, or I'm coming in for my annual WellCare. That's how they are going to bill it. When you get in there for your appointment, you can't go in there saying, oh, I got aches and pains and blood pressure's high and my back hurts and so forth, because that's not considered WellCare. You're coming in for a diagnostic. Something's wrong. Let the doctor tell you what's wrong with you, not you tell the doctor what's wrong with you.
Gotcha.
9 times out of 10, you just come in, tell them I'm here for my annual WellCare. They'll do a screening. They'll ask.
They're going to ask. So it's hard to say.
Yeah.
They're going to ask me if I have an ache and a pain.
Yes. They're going to ask. And then they'll code it differently and bill you, and it'll fall to your deductible. Oh. So you just have to watch
what you say,
and how you say it.
So what should I say? I don't know. You tell me.
Yes.
That's you tell me what's wrong with me.
I don't know.
Yes.
What do you
I'm
think?
just here for my WellCare visit.
What do you think?
They're automatically going to.
You're like snotting everywhere. Like, well, I don't know.
You tell me.
Yeah. So it just depends. If they know that you're coming in snotty, they're going to tell you, are you sick? Yeah. They're going to ask you, are you sick?
And you can say yes. Or you should still say, you tell me.
Or you could just say, I haven't been feeling well, but I'm not, and then.
The United States, the things we have to do to just.
Absolutely. It depends on how you and your physician are.
Yeah.
I mean, mine, I can walk in and say, Karen, I'm having a bad day. And she'll be like, okay, we'll get you taken care of, you know, and she'll still bill it as a WellCare check.
Yeah.
So it just depends on what type of relationship you have with your physician.
Sure. What do you think, because I've learned so much in the past month, and I have to tell you, I just went into my portal and have the app on my phone now, and I've learned so much. What is the biggest aha moment people have when they learn about the HSA and how to use it correctly? What do you think the biggest, like, oh, that is amazing, or like, I love this, or, oh, I wish it did this?
I think that once they learn that they can actually save money on the front end instead of spending a ton of money on the front end and getting no benefits is amazing.
Yeah.
I mean, because if you're on a basic plan and you're never using it, you're spending probably $1,000 a month in premiums and you're not using it.
Yeah.
So going to a HSA can save you anywhere from 15 to 20% of your premiums. Drop that money into your HSA and now you've just saved yourself a ton of money. You've got great healthcare insurance. Well, I can't say that all healthcare is great, but you've got catastrophic coverage if something should happen, and then you can spend it where you need it.
Yeah. This is another question. Maybe a lot of other people have this question too, is so I put my money in there this year, say I contribute $1,500 and I don't use any of it. What happens at the end of the year?
It just rolls over.
Okay.
So with health savings account, your money will continuously roll over every year. Okay. If you happen to leave that employer and go to a different employer, that money is your money. It'll continuously roll over. You can no longer contribute if you're not enrolled in a high deductible health plan, but that money is yours.
Okay.
Okay. That Benny card will continuously work until there's no money on it.
Swipe that Benny card.
So if you moved to a different company, like you said, and they don't have their health plan, like you get on it, but it's not a high deductible one.
Yes.
You still have your HSA, you still have that health savings account. You personally can still contribute to it, correct?
No.
No, you can't.
No. If you're not enrolled in a high deductible health plan, you cannot contribute.
Okay.
If they do have a high deductible health plan that you decide to get onto, you can transfer your current HSA funds into the new funds with your new employer and just
Continue to build it.
Continue to contribute and basically just do away with the old company benefit card.
Got it. So that would go away. You wouldn't be charged, like a lot of investment accounts, I'm just thinking, there's penalties if you close them out. So this would not be considered a penalty.
You can transfer.
Okay.
Yeah. You would just have to have that benefit company contact the old benefit company with your information, and then they can transfer the funds to them. They'll send a check.
So something else came up for me at that moment. Say, like, I'm continuously just paying little by little from my paycheck to my HSA, and I decide, like, hey, this month I don't want to contribute that. Is there a flexibility throughout the year in adjusting that? Or is it okay?
It is. Now, your payroll company may not like it, but you can stop a contribution if you choose. So say that you've maxed out your account for this year.
Yeah.
And then next year you don't want to contribute anything. You don't have to contribute. But then you notice that you've used some of that money and you want to start contributing halfway through the year, you can pick that contribution back up.
Okay. Because I wasn't sure, sometimes there's like open enrollment periods. And is that the only time that you can change things?
No.
It's not that way.
Open enrollment periods are basically for health insurance. And they set those so that you don't jump off and jump on the plan. Okay. So what happens is when you're enrolled in health insurance, some people get on just because they need, a heart catheterization or something of that sort. They'll get on just to use the benefit of the plan and then they'll get off. Well, once you get off, you cannot come back onto the plan until open enrollment.
The next year, whenever that may be.
Or if you have something like a life event happen, say that you've been on your spouse's plan for the last 12 years, he lost coverage, then you can come onto the plan.
I see.
Wow, I never knew that. I'm learning so much. I love to learn on an episode. So one of the biggest things with HSAs is we talk about how I said earlier, a triple tax advantage account, meaning you get that money pre-tax, get the full dollar. We love the full dollar. And then if you're choosing to invest that money, it grows.
Yes.
Tax-free.
Yes.
So let's talk about that. We talk about contributing, however you want to contribute, whether it's quarterly, every paycheck, however that works. Is that money, let's say I opt to invest that $1,000. It's in there. It's investing. I picked a plan. every week, do I have to move that money into the investment account, or does it automatically start investing that money for me? And maybe that's too technical of a question, but
So basically, your contributions stay in that account until you move it.
so you got to
So
manually
you would
move
have
it.
to move your money to an investment account that you want it moved to. It won't move on its own.
Okay.
Okay. So
Well, that's so important, because if people, I mean, I think about this, people like open up Roths and then they don't fund their Roth, or that
Yes.
people think they're investing for so long, but they didn't take the next step to actually do what you needed to do to get it moving.
Right.
Yes.
And then a year has passed and you're mad, right?
yeah, because they thought they were
Because the
gaining
market
money.
was good that
Yeah.
year.
I know and I've loved getting into our portal and looking at all that. And once you hit that like minimum, you can click this button and it says you can elect to have once it hits that minimum, you can have of that
Additional
threshold.
money.
It'll transfer it.
Oh.
So if you select those 3 investments or however many investments, you just click the button and for each of them, and then it said it would transfer for me, which I was like, good, because I don't want to come back here every month.
Every
but make
month
sure
and
that you
change it.
tell it what to do.
Yes.
Yeah.
Yes.
Yeah.
I think the other big thing, talking about how it is tax-free, and I'm contrasting with like the people that are wanting to spend this money so quickly. And in some circumstances, people certainly need the money. I'm not saying that they don't. If they have a medical event that they need paid for, I'm not saying don't. But we talk a lot about if you're doing okay, like if you're young, healthy, and don't have medical problems, this is such a great account to take advantage of for the tax purposes, to invest in, not only save, but make more money.
Yes. Yes.
Because one day,
eventually you're going to use it.
yeah.
Eventually you're going to need it.
Yeah.
And
You will
eventually
need
you're
it.
going to use it. So even if you're contributing into this HSA and it continuously, you're rolling over just say $4,000 annually,
Yeah.
it builds. At some point, if your deductible is only $5,000 or out-of-pocket maximum is only $5,000, I'd take $4,000 that you just banked for that year and I'd throw it into an investment.
Yeah.
And let it set and accumulate for the next 10 years.
Yeah.
And then at retirement age, when you hit 65, you can start using that money out of your HSA and paying yourself tax-free, or paying your Medicare premiums, or paying whatever you might need.
And what we talked about is that healthcare is just going to keep getting more expensive.
Right.
So
Yes.
it's not, I used those examples with you the other day. I was like, what if I never have a problem with my health again? You're like, okay, Ashley. It's like you're going to like,
Eventually,
Well, the closer to retirement you get,
You're
the
probably
more
gonna be
likely
paying
there's
more.
going to be some
and they
kind of
say
health.
every 7 years your body changes.
Oh.
So every 7 years, you're bound and determined to have something happen.
Yeah.
Something's going to change.
Well, even that staggering number we learned when we read that book, Smart Women Finish Rich, it was like 1 in 4 people experience some kind of
disability,
disability.
but before the age of like
30.
30. It was
Yeah,
insane.
it was insane. So, I mean, the chances of you having something happen or somebody in your family are pretty high.
Yes.
Yeah. But you get that entire, so the investment as it grows, you don't have to pay taxes on the growth. This is the
Right.
only account, the only investment account where you don't have to pay
Pay
money
ta-
on the
yep.
growth or taxes
Yes.
on the growth.
Yes.
Yeah. It's exciting for me.
It
anyway.
is.
I nerd out
It
over
really
this.
is. I mean, and it's all about education.
Oh, I really want to talk about this. So, talk about spending this money. Okay. I want to talk about the receipts, Jill.
Oh, yes, yes,
What's
yes.
like the best first question to ask about?
Because you talked about earlier in this episode, say you don't have any money on your debit card, your health savings account debit card, and you save that receipt and you can reimburse yourself.
Yes.
Should I talk about saving receipts, why you should do that, all that stuff?
If you're enrolled in a high deductible health plan, HSA, always keep your receipts. I have a manila envelope that every receipt that I have for healthcare goes in that manila envelope and it's stashed in my safe.
Yep.
And the reason being is because when you file taxes, they're going to ask you, sometimes they'll audit you, and you'll have to show proof that you've spent that money on medically necessary or dental, vision, whatever, items or accounts or whatever it may be. If you happen to spend that money on something outside of medical, dental, or vision or over the counter, you will be taxed on it, and you will pay a 20% penalty.
Okay. That's important.
Yes.
So, okay. So this just brought something else for me. So I'm going to Walgreens and I buy my cough syrup, my Band-Aids, whatever. And then I throw on a Gatorade. You know what I'm saying?
Yes.
Like,
And people do it.
okay.
I would purchase them separate.
Separate. Okay.
So anything that you're going to purchase over the counter that is HSA approved, purchase it separate. Swipe your Benny card because you won't pay taxes on it.
Okay.
Swipe your Benny card, and then any personal items from that point on, scan them separate.
What happens if what if you accidentally put the Gatorade on? Is the IRS coming to arrest me?
You
They probably won't, but if you're ever audited, you will see that tax
Okay.
Well, and this comes up for me too.
and penalty.
How long? So, you know, you have this HSA high deductible plan for years and you're saving your receipts, but you're paying out of my pocket. You know, like I am paying for this stuff that qualifies under my HSA out of my pocket. And then all of a sudden I decide, you know, I'm 65 and I want to reimburse myself for that 25-year-old payment and I'm still in that plan or still have my open HSA. Can you do that?
Yes,
You can.
as long as you have those receipts.
Okay. So I can reimburse myself for all these.
As long as those medical, everything that you paid out in medical, you was on a high deductible health plan,
Yep.
you can reimburse yourself.
Okay.
If you was not on a high deductible health plan and you reimburse yourself, they'll come get you.
Yeah. Okay.
To jail.
Well, I'm just thinking, you know, that, you know, today I might be able to spend more money, but when I'm 65 and retired and living off of a fixed income, hey, maybe I need that full dollar to pay my medical expenses or whatever. So maybe I want to reimburse myself for those payments. I don't
Well,
know.
and we talk about it's like if you can afford to pay it out of your pocket right now and you're comfortable with that and you're okay with that, because you're letting this money that you're not using grow
Right.
tax-free. And you're taking out tax-free.
Yeah.
And the thing about it is, if you're just going for your WellCare check, it's covered at 100%. And if you're just going for maybe a sinus infection, you know, it's $120 visit. $120 most people can afford.
Yeah, absolutely.
You know, going to the ER at $5,000 most people can't afford.
Correct.
So
Right.
it holds the employee or the member accountable for their own health insurance.
Right.
Basically, you're going to pay for whatever you need services provided,
Right.
and how you need those services provided.
And maybe you'll think a little differently about going to the ER for a
Stomachache.
scratch or, you know what I mean?
Right.
Like it'll just make you consider things a little bit more.
Yes.
Not that you shouldn't go for health reasons, but I mean, you'll just,
Correct.
not every paper cut needs a ER visit.
Right.
Yeah.
And you'll be an advocate for your own health care,
Yes.
basically.
Yeah.
You know,
Yeah.
you use it a little more lenient.
Absolutely.
So pretend I've hit retirement age and I'm starting to use up my HSA. How does that work? Like is there like, you know, with a lot of retirement accounts, you have to spend it after the 10 years or whatever it is. You know what I mean? We talked with Matt about like that kind of thing.
There's new laws in place where you have to spend it
Like if
within
you
10 years
inherit
if you inherited something.
an
Yes, you have,
IRA.
you have to liquidate it within 10 years.
Yes.
If you inherit it.
Right. But if this is my HSA plan and I'm retirement age, is there a certain point where I have to use this up by? Okay.
No.
Well, good.
Okay, so next question.
Most people will use it within the first 10 years.
Okay.
That's just a normal. Because one, they're either going to pay their Medicare premiums with it, because Medicare premiums will probably be outrageous by the time
Yeah.
I hit Medicare in the next 10 years. Yeah. So Medicare premiums, pharmacy drugs, you're going to use it at some point, but within that 10 years, not unless you've got hundreds of thousands of dollars saved up.
I'm going to
or
have
invested.
hundreds of thousands in mine because I'm never going to the doctor, remember?
You may.
I'm going to be like so sick on the couch. Like I'm investing right now. I can't go to the doctor. I care about the dollar more. No. Okay. So Jill's talking about retirement age. You retire, let's say, unfortunately, you pass away.
Okay.
You have a beneficiary on this account because you have to.
Absolutely.
Does that person now have an HSA or do they just have
Cash.
cash?
They can opt.
Oh.
So basically, Majority of the time, your beneficiary will just cash it out as cash money.
Is theirs taxed or no?
Yes.
They get
it will
taxed
be.
on that.
Yes. Or they can use it as if they're already on a high deductible health plan, they can roll it over into their high deductible health plan.
Okay.
Yeah.
Well, that makes sense.
Good to know. Because that's your money that you've been putting into it. So it's not, it ain't going back anywhere. Yeah. You gotta put a beneficiary on it.
Part of an inheritance if they get it as cash. So majority of the time,
get taxed.
They will get taxed on it, but you won't.
It depends on what the amount is. I'm sure there's ways around it.
Right.
But
another person that says ask your CPA.
Ask your tax.
I would say
consult your tax advisor.
Yes, or ask the TPA, the administrator of the account.
Sure.
They'll be able to help you more than anybody.
Okay.
Yeah. Well, I've learned a lot. I want to ask more questions, but
like, we're still talking about retirement. Okay, so we get this money, triple tax advantage.
This retirement.
I do too.
I do. It's important though. I think it's important because I want people to use it right, and I want to use it right. And I think this is interesting that once you hit that age of 65, and correct me if I'm wrong, you can use it on non-healthcare purchases, but you do have to pay tax. You just don't pay a penalty, correct?
Correct.
I'll say that again.
So if you're over the age of 65, you can use your HSA money on anything that you'd like. You pay taxes on it.
Non-health stuff. So if you want to buy a new pair of shoes, you can use your money. You can go buy the
new pair of shoes. You just won't pay a penalty. You won't be penalized at 20%.
Okay.
For it not being medical, dental, or vision over-the-counter related.
Well, that's good to know.
HSAs should not be anything scary to anybody.
Yeah.
As long as you do your homework, as long as your I'll say broker or benefit consultant or whomever educates you on it, it shouldn't be a scary conversation.
Yeah. I was going to ask you, like, if you could tell anybody or any of our listeners something like
that's like a misconception about HSAs, or like what's the scariest, or maybe like a mistake people make.
Yeah.
I just think that the negative on an HSA is that you're going to put money into an account and you're never going to get it back, which isn't true. That's a flexible spending account. Those are
FSA and HSA are way different.
They are way different. Yeah. So HSAs, your money is your money. If you contribute into that account, that's your money. You take it with you wherever you go, whether you leave an employer or not, it's your money. Even if the employer contributed into that account, it's your money. A lot of people think that they just lose it, and you don't lose it. You have to use it eventually somewhere throughout your life.
And you can use it on shoes when you're 65.
Yeah.
I love it.
Or a new swimsuit or a vacation.
Right. But I think, so I follow a lot of like financial influencers online. And so there's a lot of buzz right now with this HSA and how it's a triple tax benefit account and all this stuff. So I'm glad that we got you on here today to kind of like really dig into what it is instead of following somebody online and getting misinformation and not using it correctly.
Absolutely.
Especially as somebody who just is using it for the first time.
Absolutely.
Yeah.
And a third-party administrator can be either a banking institution or credit union or something of that sort. Individual policies that people purchase on their own, most of the time, sometimes the carrier will be a third-party administrator for you, or your local bank.
Okay. That's another good question. You know, say I am self-employed and I have a high deductible plan. Where can I go to open, or can I go open my own, like you just said?
You can go open your own, but you would have to do your homework. Some banking institutions do offer individual HSAs. Some credit unions do offer individual HSAs. Sometimes the account that you wrote it through, whether it be Blue Cross or United Healthcare, Cigna, Aetna, sometimes they'll offer an individual HSA. You just have to do your homework on it.
That's good. So if there are businesses, employers, what kind of businesses, if they were looking to open an HSA or start an HSA for their company, or just, would they come to you, Tasha, or how
they can?
Okay.
Yes. If it's a commercial account, group insurance, they can actually come to me, or they can go to their broker and ask their broker questions, information to provide them. Some brokers shy away from HSAs. I do not.
Yeah.
It's all about education.
Yeah.
And it's all about educating your employer group. But yes, all of my commercial accounts, I can provide them with the TPA to administer their HSA.
Very cool. Is there any specific business that you think this is really great for? It's probably not an easy question. But what kind of businesses do you see most often, I guess? Is it schools? I don't know.
Or maybe like the type of people that are working for the like age, or I'm sure there's lots of factors that go into play.
HSA is good for every account.
Yeah.
I'll just say that if I was an employer, I would offer HSA and a first dollar benefit account, depending on how large my company is, just to give the employees an option of what they want. But then if I have a small group account, I would probably, and that when I say small, I say under 100, I would probably stick with HSA across the board.
That's good to know.
It's a big company still, under 100.
Yeah. Well, this has been fun.
I've enjoyed it.
Any last words you want to leave with our listeners about HSAs?
Don't be afraid to dig into it and see what it's all about. Educate yourself.
Yeah.
Educate. Because the more education you have, the more education you can educate your employees, and the better they use it, the better your premiums are going to be along the road. Because yes, health insurance is a demon that nobody likes to talk about, but your premiums are based on how your plan is used. Oh. So if your plan has a high utilization and they're just going to the ER and that plan is paying $5,000 and $10,000, $15,000 per member every time they go to the ER, then you're going to get a nice premium increase at the end of the year because your employees use your plan.
Your stuff.
Yeah, they utilize.
That's a great last thing to say is like, you said it, Tasha. Educate. It's like, I didn't know that. I didn't know that the behavior of the employees influences so much how much the employer is going to pay.
Yes, it really does.
So that's fantastic.
I just say education is a big tool when it comes to health insurance.
For sure. Well, thanks again for being
You're
on
welcome.
today.
Thank you,
Thanks for having
Tasha.
me.
I've learned so much.
Thanks for having me. I appreciate it.
Thanks to our listeners. We'll see you next week.
So, Jill, where do we go from here?
Be sure to check out our show notes for this episode, and also be sure to follow us on social media and subscribe to our newsletter. And we'll see you next week.
See you next week.